How did Cholamandalam Finance cross the massive 2.24 lakh crore assets under management milestone? Let us look under the hood of a compounder with this earnings breakdown. The structural outline of this deep dive takes us through four key segments: the big numbers for Q4 and FY26 performance, the core growth engines, the balance sheet health analyzing profits and margins, and finally the valuation and verdict weighing the bull versus bear case. Starting with the big numbers, Cholafin's total income hit 8,538 crores, up 19.9% year-on-year, reflecting an expanding franchise cross-sell value. Assets under management crossed 2,24,334 crores, growing 21.4% year-on-year, which firmly cements its upper-tier systemic NBFC status. Net profit after tax reached 1,640 crores, an impressive 29.5% year-on-year expansion in high-quality reported earnings, while the quarterly return on equity achieved a stellar 23%.
Looking at the scale-up and how they are financing the real economy, the disbursement growth trend shows a steady climb from 85,000 crores in FY23 to 95,000 crores in FY24, 1,01,000 crores in FY25, and hitting record FY26 disbursements of 1,11,642 crores. This marks a 10.6% year-on-year increase. A Q4 surge of 24.5% year-on-year was driven by heavy commercial vehicle replacements and semi-urban retail traction, while loan advances grew 19.5% to 2.17 lakh crores, acting as the primary growth engine. Translating revenue into bottom-line power reveals a broad-based operational revenue growth of 19.4% year-on-year. Effective cost control through an optimized borrowing mix contained finance cost increases to just 2.9% quarter-on-quarter, despite rate pressures. Furthermore, strict operating expense controls improved operational leverage across their 1,761 branch network, which translates to a massive profit before tax growth of 25.2% year-on-year, reaching 2,137 crores.
This leads to significant margin expansion and digital efficiency, where the net income margin expanded by 40 basis points year-on-year to 8.4%, driven by a shift toward high-yield loan categories. Simultaneously, the cost of funds improved to 6.6% via brilliant wholesale source optimization, insulating spreads, while the cost-to-income ratio dropped to a lean 37.7% as digital onboarding frameworks scale up efficiently. This success is powered by a multi-engine ecosystem, where vehicle finance remains the anchor, contributing roughly 52% of revenue, with an 18% profit before tax growth and a managed 3.84% Stage 3 risk. Loan against property serves as the profit accelerator, with 45% profit before tax growth and a 2.24% risk profile, while home loans provide a structural pivot with 21.7% profit before tax growth and exceptional cost control, maintaining the lowest risk at 1.33%. Meanwhile, the consumer and small enterprise loan and SME segment acts as the yield improver, driving digital velocity and net income margin expansion with closely monitored risk. Turning to the balance sheet health, we see a capital fortress where the capital adequacy ratio stands at a robust 19.21%, with Tier 1 capital at 14.73%, well above the 15% RBI mandate. Debt to equity improved to 6.94x, down from 7.40x year-on-year, indicating high capital comfort. Additionally, the liquidity coverage ratio sits at 156.7%, crushing the 100% regulatory minimum. An analyst check on the operating cash flow myth addresses a common red flag. The cash flow statement shows a negative 29,920 crores in operating cash flow, which looks alarming to traditional investors. However, the reality in NBFC accounting is that aggressive loan generation is recorded as an operating cash outflow, meaning the business is growing fast, while the core truth is that pre-loan operational cash generation was actually a massive positive 23,844 crores, proving the engine is generating immense cash. Asset quality is protected by a prudence cushion, where gross Stage 3 assets are managed tightly at 3.05%, while net Stage 3 sits comfortably at 1.63%. The auto portfolio provision coverage ratio was hiked to 49.19% to insulate against cyclical vehicle disruptions, and as an extra layer of armor, management proactively booked a 200 crore voluntary macro overlay provision to guard against geopolitical and economic variations. This brings us to the valuation paradox, where trailing price to earnings dropped from 28.1x in FY25 down to 21.9x in FY26, while the price to book ratio sits at 3.8x, notably below the historical average of 5.4x. Multiples compressed because the 25% earnings growth heavily outpaced the stock price expansion, meaning the stock became fundamentally cheaper because of its outperformance.
The structural tailwinds supporting the bull case include successful diversification beyond auto cycles into structural, multi-year mortgage, and MSME credit portfolios. Their deep distribution network spans 1,761 branches, with 88% rural and semi-urban penetration, creating a sticky, low-competition customer base, while this compounding machine is historically backed by an elite 15-year disbursement compound annual growth rate of 20%. On the flip side, the key investment risks highlighting the bear case include a heavy reliance on wholesale funding, which exposes margins to rapid shifts in systemic banking liquidity. There is also a new business seasoning risk, as high-yield unsecured loans carry structurally higher baseline credit losses, while the execution burden of scaling newer high-yield verticals requires flawless early-stage collection discipline to maintain current profitability.
The final verdict and synthesis from the analyst desk gives an overall constructive stance. The core thesis is that Chola is successfully executing a complex transition from a single-product vehicle lender into a diversified, multi-engine financial powerhouse. The forward outlook suggests superb profitability with a 23% return on equity combined with highly prudent risk provisioning, setting an incredibly strong foundation for FY27 compounding. If you found this Cholamandalam Finance earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.